What was going on with silver? If you're not in it already, consider joining in shortly, because when this thing comes out of this congestion, it's going to produce it very quickly. And if you join in at $300 or $500, you're vulnerable to a sharp pullback, okay? But silver will already then be in a new reality, and I think it's going to occur quickly. And there's, like I said, there's all kinds of reasons for it, including that money supply reason. Silver was the opposite. It was not overbought for too long. It was suppressed for too long, depressed. But when we measure the momentum of silver long term, not just look at the price chart, I think silver's going to do it in a tantrum. It's not going to let you on board in an easy way. If you're not already on board, it's a little late. You've seen the movie, The Big Short, okay? But 3 or 4 guys in that movie, different parts of the country, realized what was coming. But they realized it 2 years before it started. So timing is important, okay? As I explained, silver stuck in this 50-year range until late last year. You'd be up in that $200 to $300 level to $500, just to match $50 highs we've seen in the past. Our measurements right now indicate that you've likely seen your low, your washout low. It wasn't the Feb low, it was that March low that spiked through the Feb low, stopped everybody out who was a price chartist. Said, I'm out, I'm gone. You know, of course, they bought it silver at $100 as opposed to 56 or something. But I think we've cleansed the market. The issue now is to prove that we're coming out of here. And I think as the headlines start to dissipate. Go back a year, for example, and put yourself in the stock market, for example. Do you remember Jan, Feb, March of 2025? The stock market was plunging, especially in March and April, because of, quote, tariffs. Okay. Tariffs hadn't even been on the talking points. So it was suddenly a new fundamental. And everybody's, oh my gosh, it's, you know, the world's going to, et cetera, et cetera. And they sold stocks. What happened to them? They got killed by shorting those markets. Now, the same thing happened recently in stocks, although I think stocks are in a major topping process, with the war news. So if you sold the headline, you got reamed, okay? The same is true with the monetary metals. The people that sold that thinking, oh, we're going into a global depression and therefore inflation's over, you know, that kind of thing. Or oil is going to go up so high that we go into a depression and therefore there's no more reason to buy gold. Okay. Those assumptions are transient and they were false.
Markets rallied after panic headlines, but the investors who sold precious metals on recession fears may have walked straight into the trap. As Michael Oliver points out here, the biggest losses often come when retail reacts emotionally to narratives institutions quietly fade weeks later. Tariff panic in early 2025 triggered forced selling, yet liquidity conditions never confirmed a lasting deflationary collapse. That matters because savers dumping hard assets during manufactured fear cycles usually re-enter at dramatically higher prices. Next, Michael Oliver exposes why the recent silver washout may have been engineered to reset positioning before the next acceleration higher.
You've got to keep with the major trend. And I think it's going to resume, and I think silver, by this summer probably, maybe later in the summer, will be reaching levels that to us make sense on a variety of reasons, and that is between $300 to $500 an ounce.
Yeah, Mike, I'm curious here also because you've used the word a new reality. What makes you choose that word reality? And in your mind, in your vision, what are you seeing to use that word reality?
Well, it's silver. Think about silver compared to certain other things over the last decades. Between the late 70s and late last year, so 50-year span of time, silver was caught in a little rectangle. Between $4 and $4 and $50, it's like that's where it lived. And 50 was deemed to be, that was high, okay. But during that same 50-year period, look what gold did. The mama monetary metal. Silver's a monetary metal. Don't forget that. It's not just industrial. It's been money for 3,000 years, and it is still. So it moves with gold in its big moves. But gold blasted out each of those highs over 50 years. Remember, in 1980, it reached 850, okay? Then 2011, it reached 1920. And then we were well above that when silver is still capped below 50. What's going on? What's the game here? Who's capping it? Then you look at copper. Okay, a boring base metal. Okay.
The official inflation story collapses when one monetary metal stays artificially frozen for half a century, while everything else reprices higher. Michael Oliver notes that silver remained trapped under $50, even as gold, housing, food, and money supply exploded upward across multiple economic cycles. That contradiction forces a harder question. Was silver truly weak, or was price discovery repeatedly suppressed to maintain confidence in fiat stability? For long-term investors, this disconnect matters because delayed repricing events rarely resolve gradually once institutional control weakens. Next, Michael Oliver unravels why copper and lead already entered a new reality years ago, while silver remained strangely restrained.
Okay. It was caught in a range of price reality between 50 cents and $1.50 a pound for decades. Okay, just like silver was caught between 4 and 50, 4 and 50, 4.50. Okay, copper in late 2005 decided on its own, without being part of some mob move by the metals, it was on its own. In late 2005, finally decided to break out above that multi-decade range at $1.50, and within a couple quarters, it was at 4.50. It tripled its reality, but it took out the top of that range in a couple quarters. It changed its reality, not 2 years, a couple quarters. And then after that, yeah, there were sell-offs, but it lived in a new reality. It was roughly, $3.50 on average, as opposed to the old average price of $1, 50 cents to $1.50 for decades. So it went into a new reality. Lead did the same thing. Lead, okay, exciting metal, right? In 2007, it did what copper did in 2005. It went into a new reality and lived there after that. How come silver, gold didn't live in an old reality? Copper didn't, lead didn't. What was going on with silver? Well, there's arguments that are valid that, there have been efforts to contain it. Okay. Well, anybody who tried to do that was standing on a stick of dynamite, okay? Because ultimately you can't fake reality. And if silver is justified to be at a higher level than $4 to 50 forever.
The same pricing pattern appeared just months before previous commodity repricing shocks rewrote entire sectors overnight. According to Michael Oliver, copper and lead didn't gradually rise out of multi-decade ranges. They violently reset into entirely new valuation zones within quarters. That timing matters because markets suppressed below monetary reality tend to overshoot aggressively once structural pressure breaks containment. Investors waiting for confirmation often discover the move already happened while financial media still debates whether demand is real. Next, Michael Oliver reveals why any long-term cap on silver may have created the exact conditions for an uncontrollable breakout later.
Then we know, if you've been in markets long enough, you've seen markets create excess. Like stock market tops that get overbought for too long. And when they go down, they often go down more than they probably should to correct for the error of being overbought for too long. Well, silver was the opposite. It was not overbought for too long. It was suppressed for too long, depressed. And so it said, hey, I'm out of here, okay? So don't be shocked if it replicates copper and lead, which tripled within a couple quarters after emerging out of the price base, and or gold making the new highs all the time. Now, we measure this. We don't just look at the old charts and say, well, they did it, so silver can do it. Okay, that's fine. It's an interesting archival thing to look at. But when we measure the momentum of silver long term, not just look at the price chart, we knew back in June of 2025, when silver was coming up toward $35 for a third time in a year, again, in the middle of that range, $35, okay? We said, okay, the acceleration phase is commencing. And it did, okay? By the end of the year, we were in new highs. And, we not only got above 50, we got above 100, okay? And I think all we're having is a congestion zone here, which also in the copper move that I mentioned and the lead move, there were periods in the middle of that surge where there was a violent downturn. And it looked like, oh, it's topped.
If this consolidation continues only a few more months, many conservative portfolios could miss the fastest phase of the entire metals cycle. What Michael Oliver is highlighting is that silver's structure resembles historically suppressed assets that eventually explode higher after years of artificial restraint. Most investors mistake violent pullbacks for collapse when they may actually signal institutional repositioning inside an ongoing acceleration trend. That becomes dangerous for retirees and savers because hesitation during revaluation phases often destroys purchasing power permanently. Next, Michael Oliver exposes why the sharpest downturns inside commodity supercycles frequently happen right before the most explosive advances.
Okay. It doesn't top with the first high. It's maybe the second one, it will. But the second one was very dramatic. Anyway, so I think the monetary metals, and they have good reasons fundamentally for doing this, are merely having a violent shakeout trading range that is now ending, and we're about to engage in the next phase, which should be even more dramatic than the first phase.
Yeah, when you're talking about silver and archival and the history of it, I recall, the stories of the Hunt brothers and how they moved into silver, cornered the market,
Yeah.
and I
Yeah.
believe the government got involved and kind of had them exit the silver market, and
Yeah.
shortly after, Warren Buffett went into silver, and talking to a professor at NYU, he had mentioned how Buffett went into silver and he uncharacteristically got out of it as well. So maybe there were some landmines if you wanted to go into silver
Yeah.
back then, and maybe they're still around today. Who
Yeah.
knows?
Yeah.
Anything in your momentum models, or are they picking up early structural signals pointing to let's say bifurcation between the paper metals and the physical metals, because things seem to be heating up there as well?
Well, I know that there's some debate about the difference here and there, and a lot of people are looking at issues like, the open interest on the COMEX, or whether the COMEX will raise margin rates and all this stuff. But that won't stop reality, because remember, if reality's been contained artificially, again,
COMEX positioning keeps expanding while physical silver availability tightens underneath the surface, and that divergence rarely ends quietly. This is where Michael Oliver's thesis shifts from price speculation into structural stress inside the metals market itself. The Hunt Brothers episode taught institutions how aggressively rules can change once silver threatens broader financial stability. But it also exposed how fragile paper pricing becomes when physical demand overwhelms leverage. Investors focused only on futures charts may completely miss where actual scarcity pressure is building. Next, Michael Oliver points out the specific positioning tactic in COMEX reporting that may be masking real institutional demand.
as I explained, silver's stuck in this 50-year range until late last year. Nothing else has. I mean, you look at, for example, when your granddad built a house, it was $450. No, it should be $4,500. And then when your dad built one, it was $45,000, and the median home price now is $450,000. Okay, those haven't been restrained. The price of bread has also gone up quite a bit. You name it, they've gone up. Why? Because of the underlying degradation in the money unit. And if you go back to 1980 and ask yourself, look at an M2 chart, money supply, and look where it is there and where it is now, and look at the gain it's had. Okay, or go back to 2011 when silver also hit 50 second time. And look where money supply was then versus now. Silver's finally saying, hey, I'm going to catch up to reality. I'm going to price myself. If it even went back to price levels equivalent to the M2, to the money supply that it saw in 1980, you'd be at that, or 2011 even, you'd be up in that $200 to $300 level to $500, just to match the $50 highs we've seen in the past in terms of real dollar value, okay? So there's all kinds of factors at play here, and I think silver's going to do it in a tantrum. It's not going to let you on board in an easy way. If you're not already on board, it's a little late, but I still advocate,
The Fed insists inflation is moderating, yet nearly every real-world asset has repriced exponentially higher over the last 4 decades. Michael Oliver notes that silver alone remained trapped, while housing, food, wages, and money supply exploded upward across multiple monetary cycles. That disconnect exposes the deeper issue most analysts avoid discussing. Fiat dilution never stopped, but silver's price discovery may have been delayed unnaturally. For wealth preservation investors, the danger is assuming yesterday's suppressed pricing still reflects actual purchasing power reality today. Next, Michael Oliver exposes the one monetary metric suggesting silver may still be massively undervalued even after its recent surge.
If you're not in it already, consider joining in shortly, because when this thing comes out of this congestion, it's going to produce it very quickly. And if you join in at $300 or $500, you're vulnerable to a sharp pullback, okay? But silver will already then be in a new reality. And I think it's going to occur quickly. And there's, like I said, there's all kinds of reasons for it, including that money supply reason. And, and that will be reflected. Well, if, for example, you go back to 1980 gold and money supply, gold's beat money supply nicely, okay? S&P has only matched it. Since 2000, the dot-com high, you go back there, 2000 high, where M2 was, or where S&P is now, S&P has merely matched the degradation in the money unit, the quantification increase in the supply of money, therefore its real buying power. So all it's done is hold its real buying power, not really gained, although it looks great on a chart, So anyway, that's the reality I think we're facing, and I think the T-bonds and the financial sector, we're particularly watching some key banks, some of which don't look particularly good, on momentum. Price chart hasn't smacked you in the face yet, but momentum is telling us, this guy just broke a leg. That guy broke a leg. That shouldn't be, we're not talking regional banks, I'm talking the biggies. So the weakness we're seeing in the financial sector, the likely weakness in T-bonds, which will provoke the Fed to go ape, all these things combined create a new reality.
Major banks are weakening beneath the surface at the exact moment retail investors are being told the system remains resilient. According to Michael Oliver, momentum deterioration inside large financial institutions resembles early signals that appeared before previous systemic stress cycles accelerated into public view. The critical timing issue is that markets usually recognize banking weakness long before headlines admit liquidity problems exist. By the time the average saver reacts, central banks are already deploying emergency measures that debase purchasing power further. Next, Michael Oliver walks through the exact sequence connecting weak bonds, fragile banks, and the next major metals repricing phase.
Yeah, that word is going to stick with us. Regarding the banks, I don't know if you're able to mention them or not, if this is something just for your subscribers or not, but they're not just banks in one particular country, they may be banks throughout the world.
Well, yeah, but I'm looking at our major banks, the big names. And I'm not going to pick on them because, frankly, they're all technically about in the same condition, some of which have already broken some initial key momentum structures. Not the kind that will provoke a collapse. That might come later. But they've done enough momentum damage to say, don't trust them anymore. And the rest of them that haven't broken the structure are so close to doing so that if they sneeze, they're going to break it. And you've got to go back to that 2007 period when very few guys anticipated what was going to happen. You've seen the movie, The Big Short, okay? But 3 or 4 guys in that movie, different parts of the country, realized what was coming. But they realized it 2 years before it started. So timing is important, okay? So they knew what reality was coming, and they were laughed at for even suggesting that there was going to be a mortgage crisis. And Ben Bernanke came out in the mid-2007, no, there's no mortgage problem. It's all under control. Okay. Anyway, so they were right, and the issue is the technical timing. But back then, when you measure, again, the financial sector versus the S&P on a relative basis, you saw something going on there on a relative performance basis. Why was the financial sector suddenly getting weak relative to the S&P? We're seeing the same thing now. Yet everybody's looking at a narrow view of the tech sector.
Banks continue reassuring investors about stability, while relative performance metrics quietly deteriorate behind the scenes. What Michael Oliver is highlighting is that major financial institutions are showing early-stage technical fractures similar to the pre-2008 environment, long before mainstream analysts acknowledge systemic danger. The contradiction becomes impossible to ignore when central banks publicly promote confidence, while liquidity-sensitive sectors steadily weaken underneath broad index strength. For retirement savers heavily exposed to financial assets, these subtle momentum shifts matter far more than optimistic television narratives.